There's a saying in the markets, don't fight the Fed. But there is a more important rule that almost no one follows. Don't fight the accountant. For the last 40 years, the price of silver and gold has not been determined by the physical metal you can hold in your hand. It has been determined by unallocated contracts, digital promises to pay metal that doesn't necessarily exist in the vault. The system, often called the paper market, allowed bullion banks to trade hundreds of times the amount of actual silver available. It created a leverage ratio that some analysts estimate at 300 to 1. For every 1 ounce of physical silver in a vault, there were 300 ounces of paper silver flying around London and New York. This system worked for one specific reason. It was free. Under the old banking rules, Basel II, holding a massive short position in unallocated gold or silver, cost the banks almost nothing in terms of capital reserves. It was treated like a currency trade. Low risk, low cost, high volume. But on July 1st, 2025, the rules of the game changed forever. We are not talking about a temporary policy shift. We are talking about the Basel III Endgame. The United States Federal Reserve, along with the FDIC and the OCC, has begun the transition to a new set of capital requirements that turns the economics of the paper market upside down. The new rule is called the Net Stable Funding Ratio, or NSFR. It sounds boring. It sounds technical. It sounds like something you should ignore. But this boring rule contains a poison pill for the paper silver market. It mandates that for every dollar of unallocated metal a bank holds or trades, they must now hold 85 cents of expensive long-term funding against it. Think about that change. Yesterday, it cost a bank pennies to sell $1 billion worth of paper silver. Today, under the full application of these rules, that same trade requires them to lock up $850 million in stable capital. The trade has gone from free to prohibitively expensive. In this documentary, we are going to look under the hood of the global banking system. We are going to read the actual text of the regulations. We are going to see why the London Bullion Market Association panicked and lobbied against this rule for years. And we are going to explain why the smart money is already exiting the paper market and moving into the only asset that the new rules treat as Tier 1 capital, physical allocated metal. To understand why this rule is so destructive to the old system, we first have to understand the distinction between allocated and unallocated metal. This is not just semantics. It is the legal difference between owning an asset and owning a debt. First, allocated gold and silver. This is the physical metal. It sits in a vault. It has a serial number. It belongs to you. Under banking law, this is a custodial asset. It is not on the bank's balance sheet. If the bank goes bankrupt, the liquidators cannot touch your gold. It is yours. Because it is not on the bank's balance sheet, it carries zero credit risk. Under the Basel framework, this has always been a Tier 1 asset. Second, unallocated gold and silver. This is what most people trade when they buy a spot contract or a generic certificate. When you hold unallocated metal, you do not own a specific bar. You are an unsecured creditor of the bank. You have a claim on the bank's general pool of metal. This is a liability for the bank. It appears on their balance sheet. Historically, banks loved this. They could take your money, issue you an unallocated credit, and then use that capital to trade, lend, or short the market. They operated on a fractional reserve basis, holding only a tiny fraction of physical metal against the mountain of paper claims. For decades, this was the primary engine of liquidity in London and New York. The London Bullion Market Association clears roughly $30 billion in gold every single day. Most of that is unallocated. If the banks had to hold 100% of the metal for every trade, the volume would collapse. The price would be extremely volatile. So the regulators turned a blind eye. They allowed paper gold to be treated as a liquid asset, almost as good as cash. This allowed the banks to be market makers. If the price of silver spiked up, a bank could step in and sell massive amounts of unallocated silver, shorting, to cool the market down. They didn't need the real silver, they just needed the credit line. This infinite supply of paper acts as a governor on the price. It prevents the price from realizing the true scarcity of the physical metal. As long as the cost of maintaining that paper position was zero, the suppression could continue indefinitely. So why did the rules change? It wasn't because the regulators cared about silver bugs. It was because of the global financial crisis of 2008. In 2008, the world learned a hard lesson. Liquidity can disappear overnight. Banks that looked healthy on paper suddenly collapsed because they were funded by short-term cheap borrowing but held long-term illiquid assets. When the panic hit, the short-term funding evaporated. Banks couldn't roll over their debt. They became insolvent in days. The Basel Committee on Banking Supervision, the central bank for central banks, decided this could never happen again. They designed Basel III. The goal of Basel III was to force banks to match their assets with stable funding. If you hold an asset that is hard to sell, you must fund it with money that is hard to withdraw. This prevents a run on the bank. But in their zeal to fix the banking system, the Basel Committee accidentally targeted the gold and silver market. They looked at unallocated gold and asked a simple question. Is this a liquid asset? The bank said, yes, of course, we trade billions a day. The regulator said, prove it. In a crisis, can you sell $1 billion of paper gold instantly without crashing the price? The answer, mathematically, was no. So the Basel Committee classified unallocated gold not as a cash equivalent, but as a risky, illiquid asset requiring a massive safety buffer. They created the net stable funding ratio, the NSFR. And this is where the math gets deadly for the short sellers. Let's look at the specific calculation that kills the trade. The NSFR requires banks to maintain a ratio of available stable funding to required stable funding of at least 100%. Here's how the regulator treats gold and silver under this formula. Number 1, physical allocated metal. This has a required stable funding factor of 0%. It requires no expensive funding because it is not a bank asset, it's just custody. Number 2, unallocated paper metal. This is classified as a level 2B asset or similar high-risk commodity. It is assigned a required stable funding factor of 85%. This number, 85%, is the nail in the coffin. It means that if a bank wants to hold a $100 million position in unallocated silver, either as a short hedge or a market-making inventory, they must hold $85 million in stable funding against it. Stable funding means equity or long-term debt. You cannot use cheap, overnight depositor money to fund this. You have to use expensive shareholder equity. The cost of capital for shareholder equity is high, usually 10% to 15%. So the bank is now forced to pay a 15% interest rate on 85% of the value of their silver position just to keep the trade open. Do the math. If silver is trading flat and it costs you millions of dollars a year just to hold the paper position, the trade is no longer profitable. Market making works on thin margins. If you introduce a massive capital charge, the market maker withdraws. They stop providing liquidity. They stop selling the paper. And when the seller of last resort disappears, the price is left to the mercy of physical demand. In part 2, we are going to look at the endgame. We are going to explore the specific U.S. implementation that began its transition in July 2025. We will see how the U.S. regulators ignored the desperate pleas of the London banks and decided to gold plate the rule, making it even stricter than the European version. The trap is set. The timeline is ticking. Welcome back. In part 1, we established that the net stable funding ratio imposes an 85% capital charge on unallocated paper metal, destroying the profit margin of the traditional bullion bank model. But the banks didn't take this lying down. Between 2018 and 2023, the London Bullion Market Association and the World Gold Council waged a desperate war to get an exemption. They wrote frantic letters to the regulators. In 2021, the LBMA explicitly warned the UK's Prudential Regulation Authority, the NSFR, would dramatically increase the cost for banks to maintain large unallocated gold positions, potentially undermining the system completely. They weren't subtle. They admitted the system would break. They argued that gold is highly liquid and should be treated like currency, which has a 0% charge, not like a commodity with an 85% charge. In the UK, they achieved a partial victory. The UK regulators introduced an interdependent precious metals permission. This loophole allowed UK banks to apply a 0% charge to their unencumbered physical stock if it was balanced against customer deposits. Basically, London carved out a safe space to keep the game going. But here's the problem. The market is global, and the United States did not agree to the loophole. The US regulators, the Federal Reserve, FDIC, and OCC took a much harder line. This brings us to the Basel III Endgame proposal of July 2023, which is the framework being implemented right now in 2025. The term gold plating in regulation doesn't refer to the metal. It refers to a country taking a global rule and making it stricter. The US Basel III Endgame is a massive gold plating exercise. While Europe and the UK were creating loopholes for their banks, the US Federal Reserve decided to eliminate internal models entirely. Under the expanded risk-based approach, U.S. banks can no longer use their own internal risk models to calculate how much capital they need. They must use the standardized approach set by the regulator. Why does this matter for silver? Because the standardized approach is blunt. It doesn't care if JP Morgan thinks their silver hedge is safe. The standardized approach says unallocated metal equals 85% required stable funding, period. There is no interdependent permission in the U.S. text comparable to the UK's generosity. This creates a regulatory arbitrage, but in the wrong direction for U.S. banks. U.S. banks like JP Morgan, Citi, and Bank of America are the giants of the derivatives market. If they are subject to strict capital requirements while London is loose, the U.S. banks become uncompetitive. They have to exit the trade. According to the Securities Industry and Financial Markets Association, the U.S. proposal increases capital requirements for trading activities by a staggering 129% in some cases. This is a capital destruction event. Timing is everything in finance. The U.S. regulators proposed an implementation timeline that aligns perfectly with the current market shifts. The transition period for the Basel III Endgame was set to begin on July 1st, 2025. We are living through that transition right now. From July 1st, 2025 to July 1st, 2028, banks must phase in these new capital requirements. But markets don't wait for the final deadline. Markets front-run the regulation. Banks do not wait until 2028 to clean up their balance sheets. They start dumping the toxic assets now to avoid the penalty later. This explains the strange behavior we are seeing in the open interest on the COMEX. Open interest is the number of paper contracts in existence. If the banks are exiting the paper market to comply with Basel III, we should see open interest declining or stagnating even as the price rises. This is exactly what analysts have predicted. A short squeeze not caused by buying, but caused by the refusal to sell. If a bank cannot profitably hold a short position because of the 85% charge, they will simply close the position. They will buy back their shorts. Buying back a short equals buying pressure. And once they are out, they won't come back. The infinite short seller is gone. This also impacts the leasing market. Banks often lease gold or silver to industry. This creates a paper chain. Under Basel III, a gold lease is an asset that requires stable funding. The cost of leasing gold has skyrocketed. This forces industrial users, like solar panel and electronics manufacturers, to stop playing games with leases and simply buy the physical metal to secure their supply chain. This shifts demand from the paper market to the physical market. One of the most technical but critical parts of the U.S. endgame is the death of the internal model method. Previously, a bank like Goldman Sachs could say, "Our computer models show that silver is correlated with copper, so our risk is low." This allowed them to hold less capital. The U.S. endgame says, "No more models. You must use the standardized approach." The standardized approach does not recognize these clever correlations. It treats every exposure as a standalone risk. This increases the risk-weighted assets of the trading book. Estimates suggest the capital required for market risk will increase by 75% to 100% for U.S. global systemically important banks. This is a massive tax on trading. When you tax trading, you get less trading. The liquidity in the paper market dries up, bid-ask spreads widen, volatility increases, but most importantly, the ability of a large player to smash the price with a massive paper order is curtailed. To smash the price, you need to open a massive short position. A massive short position now requires massive capital backing. It is no longer a free spoof. It is a capital-intensive commitment. The cost of manipulation has just exceeded the benefit of manipulation. In Part 3, we are going to look at the consequences. What happens to a market that has been leveraged 300 to 1 when the leverage is forced to unwind? We will look at the rise of Tier 1 physical exchanges and the inevitable revaluation of the metal as it moves from a financial asset back to a strategic commodity. Welcome back. We have seen how the NSFR places an 85% funding tax on paper silver and how the U.S. gold plating removes the loopholes that banks relied on. Now we look at the aftermath. The silver market is unique. It is the most leveraged asset on the planet. Jeff Christian of the CPM Group notoriously testified to the CFTC that the paper-to-physical ratio was 100 to 1 for gold, but could be significantly higher for silver. Some estimates put the silver leverage as high as 300 to 1. This means there are 300 claims for every ounce. Basel III forces a deleveraging. Banks cannot afford to hold the funding for 300 paper ounces. They have to reduce that ratio. How do you reduce the ratio? You have two choices. 1, increase the physical. Buy massive amounts of real silver to back the paper. This sends the price to the moon. 2, decrease the paper, close the contracts, settle in cash, and exit the market. This reduces liquidity and exposes the true price. We are seeing a mix of both. The banks are exiting the unallocated business. They are telling clients, if you want exposure to silver, you must pay for allocated storage. Allocated storage costs money. It requires warehousing fees. This pushes the paper speculators out of the market. The casual gambler who just wants to bet on the price of silver does not want to pay storage fees. They leave. Who is left? The physical owners. The market is shifting from a casino dominated by speculators to a marketplace dominated by producers and industrial users. In a casino, the house sets the odds. In a marketplace, supply and demand set the price. There's a silver lining for the banks. Basel III explicitly makes allocated physical gold and silver a Tier 1 asset with a 0% risk weighting. This is a massive upgrade. Previously, gold was often treated as a risky commodity. Now it is treated as cash equivalent, but only if it is fully allocated and held in the bank's own vault. This incentivizes banks to actually hoard physical metal. Instead of shorting the metal, banks now have a reason to own the metal. It strengthens their balance sheet. It improves their capital ratios. It turns the banks from enemies of gold into hoarders of gold. For 40 years, the silver market was a rigged game. It wasn't rigged by a smoky room of conspirators. It was rigged by the incentive structure of the banking regulations. The regulations made it profitable to sell what you didn't have. They subsidized the short sellers with free capital. That subsidy ended on July 1st, 2025. The Basel III Endgame has removed the free lunch. By imposing an 85% required stable funding factor on unallocated positions, the regulators have made the paper short mathematically toxic. Does this mean silver goes to $100 tomorrow? Not necessarily. The unwind takes time. The transition lasts until 2028. But the mechanism of suppression is broken. The banks are no longer incentivized to cap the price. They are incentivized to exit the trade or go long. We are witnessing the end of the paper empire. The $10 trillion derivatives market is being forced to reconcile with the physical reality. And in a battle between unlimited paper and limited physical, the laws of physics, and now the laws of banking, eventually win. The price discovery mechanism is returning to the mine, the refiner, and the vault. The casino is closed. The market is open.